Most people treat tax filing like a fire drill. They gather documents, they rush to get things cleaned up, they answer emails quickly, they sign, they pay or celebrate a refund, and then they emotionally shut the door. Imagine if an athlete played a championship game and never watched the footage afterward. Imagine if a pilot landed in turbulent weather and never reviewed the flight log. Imagine if a surgeon performed a complex procedure and never reviewed the outcome. You'd call that irresponsible. Yet business owners do it every year with tax season. You survived it, but did you analyze it? It's over. Or at least the loud part is. The countdown emails have stopped. The April 15th is coming reminders are gone. The urgent subject lines have quieted. If you filed on time, you hit submit. If you extended, the pressure shifted forward. But either way, the intensity dropped. And now there's this quiet space. Tax season always feels like weather. There's anticipation, then pressure, then deadlines, then release. And once it passes, most business owners do the same thing. They exhale. They close the tab. They promise themselves next year will be easier. And then they move on. That's the mistake. Because tax season isn't just something you endure, it's a diagnostic event. It is the single most concentrated financial report card you'll receive all year. Everything you did for the past 12 months, every decision, every system, every habit, gets condensed into one set of numbers. Revenue, expenses, net profit, tax liability, payments made, refund or balance due. That return is not just compliance paperwork, it is feedback. And if you don't study feedback, you repeat patterns blindly. Let's be honest, most people treat tax filing like a fire drill. They gather documents, they rush to get things cleaned up, they answer emails quickly, they sign, they pay or celebrate a refund, and then they emotionally shut the door. But imagine if an athlete played a championship game and never watched the footage afterward. Imagine if a pilot landed in turbulent weather and never reviewed the flight log. Imagine if a surgeon performed a complex procedure and never reviewed the outcome. You'd call that irresponsible. Yet business owners do it every year with tax season. You survived it, but did you analyze it? Let's slow this down. What actually happened this filing season? Did you owe more than expected? Did you extend because your books weren't ready? Did your accountant ask for documents you couldn't immediately locate? Did you feel calm because you already knew your numbers? Did you feel embarrassed? Did you feel proud? Every one of those reactions is information. Tax season exposes systems. If filing felt chaotic, that's not a character flaw. It's a workflow signal. If you owed far more than you anticipated, that's not moral failure. It's a forecasting gap. If you received a large refund and felt relieved, that's not necessarily success. It means that you overpaid throughout the year. If you extended calmly because you knew you needed more time, that may be maturity, not delay. Your emotional reaction is a data point because surprise is never about the number itself. It's about misalignment between expectation and reality. And misalignment tells you something about your systems. Here's the zero fluff truth. Tax season is not a compliance event. It is a mirror. It reflects your bookkeeping rhythm, cash flow discipline, profit awareness, quarterly estimate accuracy, documentation habits, and strategic planning. If you treat it as a one-time obligation, you miss the mirror. And missing the mirror means repeating blind spots. Let's talk about the most common pattern I see. A business owner has a decent year. Revenue climbs, cash feels strong, they're busy. They don't review profit monthly. They make estimated payments based on last year's numbers. April arrives, they owe significantly more than expected. They feel blindsided. But they weren't blindsided, they were uninformed. The profit accumulated slowly all year. The tax accumulated proportionally. But without monthly review, the math felt sudden. Sudden feels like punishment, but it was just unobserved accumulation. Now flip that scenario. A business owner reconciles monthly, glances at year-to-date profit, adjusts quarterly payments when needed, moves 25% into a tax savings account consistently. April arrives, they owe a small amount, or they owe nothing. Or they expected it exactly. The filing feels calm, not because taxes are fun, because nothing was mysterious. Mystery is what creates anxiety. Visibility eliminates mystery, and tax season is simply the annual confirmation of what you either monitored or ignored. So today is not about preparing for tax season. That's over. Today is about debriefing it, because the weeks immediately after filing are the clearest your memory will ever be. You remember how it felt. You remember where the friction was. You remember what surprised you. 6 months from now, you won't remember those details as clearly. And if you don't capture them now, they disappear. The next year feels like it just happened again. No, it didn't just happen. It repeated. And repetition without reflection is stagnation. So here's what we're going to do today. We're going to ask 5 debrief questions, not emotional questions, strategic questions. Questions that convert filing season into operational insight. By the end of this episode, you will know whether your quarterly estimate system works. whether your reconciliation rhythm held, whether your pricing supports your tax bracket, whether you are operating from profit awareness or cash illusion, and whether next tax season will feel calmer or identical. Because next tax season does not begin in March. It begins the moment you stop analyzing this one. Right now is the window. Right now is when clarity is the highest. Right now is when you can choose to improve systems instead of promising yourself you'll try harder. Trying harder is emotional. Building systems is structural, and structural changes compound. So let's begin with the first debrief question. And that one is simple, but revealing. Were you surprised by the number? Let's unpack that. Let's start with the most revealing question of all. When you saw the final number, refund or balance due, were you surprised? Not did you like it? Not was it convenient? Were you surprised? Surprise is diagnostic because surprise means expectation and reality did not match. And when expectation and reality don't align, there is a systems issue somewhere upstream. Let's break this down calmly. If you owed significantly more than expected, one of three things likely happened. You didn't know your year-to-date profit, your quarterly estimates were based on outdated information, you confused cash flow with profitability. Notice what's missing from that list. It doesn't say you failed. It doesn't say you're irresponsible. It says there was a forecasting gap. That's solvable. Now let's examine each scenario. Scenario 1, you didn't know your profit. This is the most common. You were busy, revenue was coming in, expenses were going out, but you weren't looking at net monthly income. Monthly. So profit accumulated quietly and tax accumulated proportionately. Then April arrived and it felt sudden. But it wasn't sudden, it was invisible. There's a difference. If you earned $10,000 in profit in January and another $10,000 in February and so on, by December, you've accumulated $120,000. If your effective tax rate is 25%, that's roughly $30,000 in federal exposure. But if you never looked at the monthly net income number, that $30,000 feels shocking in April because it was never acknowledged in February. Surprise here isn't about the IRS, it's about unmonitored growth. The solution, monthly visibility, not obsessing, just glancing at year-to-date profit. That single habit eliminates most surprise. Scenario 2, your estimates were static. Quarterly estimates are projections. They're not magic. They're based on what you believe your profit will be. If your business grew mid-year and you didn't adjust estimates, you likely underpaid. That's not reckless, that's static forecasting. Here's what often happens. You calculate quarterly payments in April based on last year's income, but this year is stronger. Revenue jumps in quarter 3, quarter 4 spikes unexpectedly, you stay busy. You never revise projections. April arrives and you owe a larger balance. That doesn't mean your system failed, it means it wasn't dynamic. Dynamic forecasting means reviewing profit mid-year and adjusting. Static forecasting means setting it once and hoping. Hope is emotional. Adjustments are strategic. Scenario 3, you mistook cash for profit. This is subtle. You had money in the account. It felt comfortable. You assumed taxes were covered, but you hadn't separated your tax percentage. So when the bill arrived, it felt like the IRS was taking all your money. But it wasn't all yours. It was partially pre-tax profit. Without monthly profit review and tax allocation, cash becomes misleading. This is why reconciliation rhythm matters. It connects cash to profit. It forces you to ask, how much of this balance is actually mine? Not emotionally, mathematically. Now let's flip this. What if you were surprised by a large refund? That's also diagnostic, because large refunds often mean over withholding or overpayment. Now some people prefer refunds. It feels safe. But from a cash flow perspective, that means you sent excess capital to the government throughout the year, capital you could have used for growth or in a high interest savings account. There's nothing inherently wrong with that, but it is information. If your refund was $18,000, that suggests your estimates were significantly higher than your final liability. That's forecasting variance. Again, not failure, variance. The goal is alignment, not overpayment, not underpayment, alignment. The emotional layer of surprise. Now let's address something important. Surprise isn't always about the amount. Sometimes it's about the direction. Maybe you thought you were barely profitable and your return showed strong net income. Maybe you assumed you were thriving and your return showed thin margins. Tax season often reveals financial narratives we've been telling ourselves. Sometimes those narratives aren't accurate. That's uncomfortable, but it's powerful. Because when your perception of your business doesn't match the numbers, that's where growth happens. If profit was lower than you believed, you may have pricing or expense structure issues. If profit was higher than expected, you may be undervaluing your own performance. Either way, surprise tells you something about awareness, and awareness is fixable. The real question isn't, were you surprised? It's why. Why did this number feel unexpected? Did you review profit monthly? Did you adjust quarterly estimates mid-year? Did you separate your tax savings? Did you reconcile consistently, or did you wait until filing season to discover your annual story? There is no shame in answering honestly, because honesty converts surprise into strategy. If the answer is, I didn't look at my numbers until January, that's not a flaw, it's a workflow issue. If the answer is, I set estimates once and never adjusted, that's not incompetence, it's static planning. If the answer is, I had money in the account and assumed I was covered, that's cash illusion. All of those are correctable, but only if acknowledged. Now here's the most important part. Surprise is useful only if it changes behavior. If you felt blindsided this year, what structural adjustment will prevent that next year? Will you review your profit monthly, adjust quarterly payments in July, open a separate tax savings account, schedule mid-year financial check-ins? One change is enough. You don't need a financial overhaul. You need one improved feedback loop, because improved loops eliminate surprise. Let me say this clearly. Tax season is not judging you, it is reflecting you. If you were surprised, that's a mirror, and mirrors are valuable. They show you what you couldn't see from inside the system. The goal is not to eliminate tax, the goal is to eliminate shock. Shock is a systems failure, tax is a math outcome. Now let's move past the number, because even if the amount didn't surprise you, the process might have. Here's the second debrief question. Did filing feel calm or chaotic? Not did you finish on time, not did you extend, how did it feel? Because feeling rushed, scattered, or unprepared is not about taxes, it's about systems. Let's define calm. Calm filing looks like this. Your books were reconciled, your P&L was current, you knew roughly what profit looked like before you ran the return. When your accountant asked for documents, you knew where they were. When questions came up, you could answer them quickly. Even if you owed money, you expected it. That's calm. Now let's define chaotic. Chaotic filing looks like this. You're searching through emails for tens. You're downloading bank statements last minute. Your books aren't reconciled. Your accountant is asking for clarification on categories. You're not sure whether certain expenses are business or personal. You're waiting on documents you forgot about, and you're feeling slightly embarrassed. That's chaos. Notice something important. Chaos is rarely about intelligence. It's about workflow. It's about document management. It's about reconciliation rhythm. It's about whether you treated bookkeeping as a monthly task or a seasonal one. Let's break down where chaos usually originates. Breakdown point number 1, document disorganization. Did you know where your tax documents were? V2s, 1099 NECs, 1099Ks, 1099 INTs, 1099 DIVs, brokerage statements, mortgage interest statements. If you had to dig through multiple inboxes and portals to locate them, that's a signal. The solution is not try harder next year. The solution is building a document capture system. One folder, one location, documents upload as they arrive, not saved randomly across devices. Tax season chaos often starts months earlier when documents are not centralized. Breakdown point number 2, unreconciled books. If your accountant had to wait while you cleaned up your books, that's a structural issue. Not because you're incapable, because reconciliation was postponed. When books are reconciled monthly, filing becomes confirmation. When books are unreconciled, filing becomes reconstruction. Reconstruction is stressful. Confirmation is calm. And here's something subtle. When books aren't reconciled, even accurate numbers feel uncertain. You're unsure whether income is complete. You're unsure whether expenses are categorized correctly. Uncertainty amplifies stress. Reconciliation eliminates uncertainty. Breakdown point number 3, year-end cleanup mentality. Some business owners treat December as cleanup month. They wait until the end of the year to categorize everything. That often leads to rushed decisions. When you categorize 12 months in transactions at once, you rely on memory. Memories fade, details blur, context disappears. Monthly categorization prevents this compression. Compression creates chaos. Cadence creates calm. Breakdown point number 4, communication lag. Did your preparer ask for clarification on transactions that should have been obvious? Did they ask about personal expenses and business accounts? Did they question inconsistencies in categories? That's not criticism, that's feedback. It suggests your financial story wasn't fully clean. Clean books tell a consistent story. Chaotic books require interpretation. Interpretation slows filing. Slowness increases anxiety. The emotional cost of chaos. Well, let's talk about something most people don't admit. Chaotic filing feels embarrassing, even if no one says it. You feel slightly exposed, like your financial habits are being evaluated. That discomfort is avoidable, not by being perfect, but by being organized. When your systems are strong, filing becomes transactional. When systems are weak, filing feels personal. Now here's the empowering shift. If filing felt chaotic, that's not an indictment, it's a roadmap. It tells you exactly where friction exists. Was it document retrieval, reconciliation, categorization, cash tracking, or communication? Each friction point is an opportunity, but only if you can identify it. Here's something critical. Tax season calm is built months before filing. It's built when you reconcile monthly, upload documents as they arrive, separate personal and business consistently, adjust quarterly estimates mid-year. March does not create calm. March reveals whether calm was built. That's why debriefing now matters, because if you wait until January to reflect, you lose clarity. Right now, you remember where the friction was. Capture it, write it down. Where did the filing slow down? Where did stress spike? Where did you feel unprepared? That's your improvement list. If filing felt chaotic, here's the shift. Don't promise yourself you'll stay more organized. Install a system. For example, create a 2026 tax folder today. Reconcile April before May 15th. Schedule a mid-year financial review in July. Open a separate tax savings account. Small structural upgrades compound. Structure eliminates chaos. Now let's zoom out. Even if filing felt calm, there's another question you need to ask, because tax season doesn't just test organization, it tests sustainability. Let's talk about the third debrief question. Does your pricing actually support your tax bracket? Because growth without planning creates a different kind of stress. Let's go there next. Now we're going to ask the question most business owners avoid. Does your pricing actually support your tax bracket? Not, did I make money? Not, did I stay busy? But, does the way I price my work support the level of tax I now owe? Because here's something that happens quietly. Your business grows, revenue increases, profit climbs, you move into a higher tax bracket, and suddenly your tax liability feels heavier. But nothing changed about your pricing model. You're charging the same rates you charged 2 years ago. You're absorbing higher taxes without adjusting structure. That creates pressure. Let's slow this down. Taxes are progressive. As income increases, marginal rates increase. That's not political, it's structural. So if your net income jumped from $60,000 to $120,000, your tax exposure changed. If your pricing didn't adjust with that growth, your margins shrink. And when margins shrink, tax feels painful, even when profit is strong. Here's the uncomfortable truth. Sometimes tax stress isn't about tax, it's about underpricing. Let's break that down. Imagine the scenario. 2 years ago, you charged $2,000 for a project. Your net margin was healthy, you were in a lower tax bracket, you kept most of what you earned after expenses. Fast forward 2 years, you're more experienced, demand is higher, but you're still charging $2,000. Now your overall profit has increased enough to move you into a higher marginal bracket, but your pricing model hasn't evolved. You're absorbing higher taxes, higher software costs, higher contractor rates, higher personal expenses, and wondering why it feels tighter, even though revenue increased. That tension is structural. Tax season often reveals it. If you looked at your return and thought, I made good money, but it doesn't feel like I kept much, that's a pricing reflection moment, not a tax failure. Let's simplify. Revenue is vanity. Profit is performance after expenses, after taxes. What is your true margin? If you earned $150,000 profit and owed $1,000 in federal taxes, your after-tax income is $115,000 before state considerations. Does that number support your lifestyle? Does it support investment? Does it support reinvestment? Does it support growth? If it does, great. If it doesn't, the issue is not the IRS, it's margin design. Tax season exposes margin reality, because until you see your full liability, you don't know your real take home. And many business owners price based on revenue goals, not net retention goals. That's backwards. You should reverse engineer pricing from desired after-tax income plus operating expenses plus reinvestment goals plus tax exposure, then determine revenue targets. Tax season gives you real data for that equation. Let's address a common resistance. I can't raise prices. Maybe. But let's test that assumption. Have your skills improved? Has demand increased? Has your positioning strengthened? Have your results improved? If yes, pricing should reflect that. If your business is operating at full capacity and you're consistently booked, pricing pressure is likely below market. Tax season often reveals this. If you felt strained by the tax bill despite strong revenue, your margin may be thinner than it appears, and thin margins create tax resentment. Resentment isn't about the IRS. It's about not feeling adequately compensated for the work you did. Now let's clear something up. Moving into a higher tax bracket does not mean all your income is taxed at that higher rate. Marginal rates apply to portions of income, but psychologically, crossing into a new bracket feels heavier. It feels like more is being taken. But more profit also means more retained income, even after tax. The question is whether your pricing structure is designed for sustainable scaling. If you double your profit and don't adjust pricing for increased operational complexity, your stress may double too. Growth without pricing adjustments creates fragility. Growth with strategic pricing creates stability. Tax season is your proof. Here's another layer. As profit grows, lifestyle expenses often grow too. Bigger home, better car, more subscriptions, more comfort. If tax season felt tight because your personal obligations increased alongside business growth, that's not a tax issue, that's alignment. Business income supports lifestyle. Lifestyle demands influence cash flow. Tax liability is the fixed variable in that equation. If you grow lifestyle faster than net margin, pressure builds. Tax season reveals whether those two curves are aligned. Here's the real question you should ask. If my profit stays at this level next year, am I comfortable with the tax that comes with it? If the answer is yes, your pricing likely supports your bracket. If the answer is no, something needs adjusting. That adjustment could be raising rates, reducing expenses, refining client mix, increasing efficiency, or repositioning services. Tax season simply exposes the math. It doesn't create it. The goal is not to avoid higher tax brackets. The goal is to grow intentionally into them. Intentional growth looks like raising prices before stress appears, increasing margin before tax becomes painful, allocating tax percentages monthly, designing compensation based on after tax targets. Reactive growth looks like growing revenue, feeling successful, being surprised by tax, and feeling squeezed. The difference is foresight. And tax season is the moment foresight either shows up or doesn't. If this season revealed that your pricing doesn't fully support your bracket, here's the shift. Don't resent the tax, adjust the model. Review your average client value, review your time per engagement, calculate your effective hourly rate after expenses and tax. Is it aligned with your expertise? If not, the solution is structural, not emotional. You don't need to double rates overnight. Incremental increases compound. 5%, 10%, new client tiering, small adjustments realign margin with tax reality. Let me say this clearly. Taxes are a percentage of success. If success increases, taxes increase. That's the design. But if you don't design pricing around that reality, growth feels punishing instead of empowering. Tax season is your financial MRI. It shows where your pressure exists, and pricing is often the hidden pressure point. Now let's move to the final debrief question, because even if your pricing is strong, even if the filing felt calm, there's one more thing to ask. Let's ask the final question. Did this tax season change your behavior, or did you just survive it? Because surviving is not the same as evolving. You can survive filing season every year. You can scramble, you can clean up, you can pay, you can promise yourself next year will be different, and then repeat the cycle. That's survival mode. But evolution looks different. Evolution sounds like I'm opening a tax savings account this week. I'm reconciling monthly from now on. I'm adjusting my quarterly estimates mid-year. I'm raising prices before next filing season. I'm installing a document system immediately. That's not emotional, that's structural. Tax season should produce system upgrades, not just relief. Relief fades, systems compound. Now let's zoom out even further, because this tax season likely revealed something deeper about your business. Maybe you realized you've outgrown your current structure. Maybe you started as a sole proprietor and now your profit level feels substantial. Maybe you formed a single member LLC, but you're still filing on Schedule C. Maybe someone mentioned S corporation status. Maybe you've heard other business owners talk about 1120S filings. Maybe you've never thought about entity structure at all. Tax season often surfaces that conversation because once profit grows, structure matters more. And structure affects self-employment tax, payroll requirements, reasonable compensation, administrative burden, complexity, risk tolerance, and long-term planning. Next season, we're going there. We're going to slow this down and unpack the business structures clearly. No hype, no you need an S Corp immediately messaging, no fear-based planning, just mechanics. We'll walk you through sole proprietorship, single member LLC taxed on Schedule C, S corporations filing Form 1120, C corporations filing Form 1120, and partnerships filing Form 1065. We'll break down what each structure actually does, how they're taxed, when they make sense, when they don't, what administrative responsibility increases, what payroll obligations come into play, and what the trade-offs are. Because structure is not about trends, it's about fit. And fit depends on profit, goals, tolerance for compliance, and growth trajectory. If this season made you wonder whether your current structure still fits your business, that's not random, that's progression. Growth introduces new questions, and structure is one of the most misunderstood levers in small business tax planning. So next season, we're building from the foundation up. We're going to talk about when a Schedule C is perfectly appropriate, when an S Corp election might reduce self-employment tax, and when it doesn't. What changes when you move to payroll? What reasonable compensation actually means in practice, why some businesses should absolutely stay simple, and why complexity is not always strategy. We're also going to bring in perspective because tax code is one thing, but experience is another. We'll likely have a few bonus episodes with guests who've navigated growth differently, business owners who scaled slowly, business owners who restructured, business owners who transitioned from sole proprietor to S Corp, business owners who chose to remain simple and profitable. Because numbers tell one story and experience tells another. But when you combine both, you make informed decisions instead of reactive ones. Let's come back to this season right now. The filing season just handed you data. It showed you how disciplined your reconciliation rhythm is, whether your estimates are dynamic or static, whether your pricing supports your bracket, whether your documentation system works, whether your structure still fits. Do not waste that data. Write down 3 adjustments you're making this year. Just 3, not 10, not a financial overhaul, 3 structural changes. Then implement them before July. That's how tax seasons get calmer. Not by hoping, by upgrading systems incrementally. Tax season is not the villain, it's the mirror. And if you use the mirror wisely, each year becomes steadier, more predictable, more strategic, less emotional, because taxes aren't chaotic. Silence is chaotic. Structure is calm. Next season, we build structure from the entity level up, from Schedule C simplicity to corporate complexity to partnership nuance, to understanding when each makes sense. We're not rushing into elections. We're not chasing tax myths. We're building understanding because informed business owners make stable decisions, and stability is the real win. I'm Lauren Twitchell, and this is the Zero Fluff Books podcast. The tax season is over. Reflection is complete. Now we build something smarter. We'll talk again soon.